Hello and welcome to the first part of my personal finance series, where we're going to be talking about financial accounts today. So it's going to be a range of different topics. We're going to talk about what are the different types of accounts you might have, the meaning of those, some example accounts that fall within those. We're going to talk a little bit about liquidity and what that means and what types of assets are liquid versus others, as well as we'll talk about your emergency fund, um, your net worth, how to calculate that and compare it against other people in your age group to see where you fall. And then lastly, we'll talk a little bit about the importance of paying down your credit cards and how those can really start to add up and work against you if you're trying to reach your financial goals. So with that, we'll hop into it. The first part here, we just wanted to talk a little bit about what are the different types of financial accounts, just to give you a grounding on some of the foundation. So the different types of accounts you might have are assets, liabilities, and retirement accounts. Assets here are just what you own, and this is things like your cash, your checkings account, your home equity, your taxable investments. And liabilities, then, on the other hand, are what you owe. So this is things like credit card debt, if you have an auto loan, if you have a mortgage. And retirement are also technically considered assets, but these are things you're setting aside for your future further down the line, not something you're planning on accessing or using in the near term. And these, some examples are a 401k, a Roth IRA, and a health savings account. And then to calculate your net worth, it's just a simple equation. You just add together your assets plus your retirement, and then you subtract out your liabilities. And we'll go through an example demo that I put together showing you how to calculate that as well. Next topic, I want to talk a little bit about liquidity. So liquidity is just how easily an asset can be converted into cash without losing value. That last part's bolded for a key reason. Obviously, any asset you have, you could severely discount it and try to get rid of it, or you could pay penalties, whatever it may be, to convert it to cash. But the key thing here is without losing value and doing it quickly. So I broke it down into 4 different categories. Cash here is just fiat that's ready to deploy instantly for any purpose. And that any purpose part is important because you could have assets that aren't necessarily liquid, but could be used for certain purposes. For example, you could have a medical savings account that can instantly be used to pay for medical bills, but you couldn't use that to, say, go purchase a new car or to renovate your home. So that any purpose is really important there. Some examples are cash, your checkings, and your savings. And then on the liquid assets, these are assets that can be converted to cash quickly without losing value. Some examples here are crypto assets. You could easily convert back to cash to spend for whatever you need. Taxable investment accounts that hold things like stocks, mutual funds, and bonds. That you could sell and convert to cash easily because there's a large market of buyers for those at any given time. And then the same thing with commodities like gold, things that have a large market where you can sell it at spot price without having to discount it. Then we talk about semi-liquid assets. So these can be converted to cash within a short time. Short time period here is subjective, but typically anything from like 6 months to a year would be considered short term, and without significantly devaluing. So you think about your home, your vehicles, your collectibles. Those things aren't nearly as easy to sell like stocks and crypto or gold. But if you did list it, it's reasonable that you would be able to sell it for fair market value within a relatively short period of time. And then illiquid assets are ones that cannot be converted to cash without significantly devaluing or paying penalties. So your 401k, you typically, for most reasons, can't access it until you're 59 and a half, unless you pay all the taxes on it and then pay typically a 10% penalty on top of those taxes. So those are things you really don't want to access or touch in the short term because of the penalties that you have to pay or devaluing them. And then building off of that theme of liquidity, it's an important concept to understand when you're thinking about your emergency fund. So what's the purpose of having an emergency fund? There's a number of different things that could happen that are completely out of your control, such as losing your job, some type of injury or illness, some type of unexpected expense. Typically is going to be a large expense with your home or a vehicle. For example, if your AC or your furnace goes out and you need to purchase a new one that's going to cost you several $1,000s, you're not going to want to have to put that on a credit card. You're going to want to have money set aside for those types of things. So what should your emergency fund be composed of? I typically say primarily cash here. Depending on your situation, it may also include liquid assets, things like stocks or gold that can be easily converted to cash. But the issue here and the risk here is that there's volatility with those assets. So as you've probably seen recently, the stock market has been going up and down a significant amount on a daily basis. So depending on when you need that cash, if the market is down for your liquid asset, then you might not have as much of an emergency fund as you initially thought you did. How much money should you have in this emergency fund? I would say an absolute bare minimum, you need 3 months of cash to cover your monthly expenses. Ideally 6 here, but it's going to be your personal situation. Are you single? Do you live alone? Are you married? Do you have a family? Do you have children? Just depending on how many people and who is depending on you financially, you might want to be more conservative and have a higher amount of months in that emergency fund. The reason I say 6 is really what the max of what you'd want here is because you start to encounter inflation risk once you go above 6 months. So let's say, for example, you have 24 months of expenses in your savings account sitting there earning maybe a 1%, maybe a 2% at the maximum interest rate per year, while at the same time inflation, at least in the recent years, is around 7-8% year over year. So there's that risk that your money in your savings account, this emergency fund, is just devaluing the longer it sits in there. So anything above 6 months, I'd recommend typically putting into some type of liquid asset that's actually going to grow, such as the stock market. Now I want to talk a little bit about net worth and understanding how do you calculate that, and then where do you stack up against others that are in your age range and their net worth. So for this, I put together a little bit of a demo calculator. So I'll hop over to that. And for this calculator, there's 5 different ones here. So this will be linked in the the YouTube video description below. But if someone else is using it when you're on here, I'll just hop to a different one and you can enter in your data. But here it's going to break down your different assets, liabilities, and retirement. And I included all the ones I could think of. This should cover a majority of people's situations. But if there's something you don't have, just put it in one of the other categories here. But as you enter in your data, it's going to automatically calculate the totals for each of those different account types, and it's going to automatically calculate your net worth as well. And I'll just change one of the numbers here for an example. Say your home's value is actually $375,000, and your net worth right now is $187,500. And I'll also have linked down below this link to the department. A government website for calculating your net worth percentile based on your age range. So here we calculate out our net worth as being 187.5, and let's just say, for example, we are 35 to 39 age group, and since we're including the home's equity in this calculation, make sure you select to count the equity, and then just hit calculate. And what this is telling us here is that this theoretical individual is in the 69th percentile for their net worth for their age group. And you can play around with numbers here if you want to project out where you think you're going to be in a certain time and just seeing where you would stack up against others. Or you can make a goal for yourself based on what percentile you want to be in and how much your net worth would need to be to get you there based on your age. And then last but certainly not least, I just wanted to hammer home the importance of paying down your credit card debt, or at least not carrying a high interest credit card that you carry a balance on. So the analogy here is that you're essentially trying to run up the down escalator as you're trying to pay down that credit card debt due to the massive amount of interest that's being accumulated on a monthly basis. Here on the right-hand side, calculated out what's the monthly interest you would be paying based on how much balance you're carrying on a monthly basis on your credit card. So for example, if you're carrying $2,500 on your credit card, and you have an interest rate of 20% on that credit card on an annualized basis, which is actually the average, so it's pretty reasonable. You're going to be paying about $42 a month or about $500 a year in credit card interest. So as you're trying to make those payments, if you're just making the minimum, you're really never going to get that down to zero. But even as you're making, say, a $100 payment, only $58 of that is actually going towards lowering your balance. And that's kind of why I talk about trying to run up a down escalator, because you have to exert so much effort just to pay down that existing balance. And then on the top end here, $10,000, which certainly people can have much more than that. It's about $167 a month in interest that you would be paying, or about $2,000 per year. So that's money that could easily be going towards something else, savings or investing or a college account, whatever it may be. What I typically recommend is that people transfer this high interest credit card debt to a new 0% interest credit card. Just do a quick Google search, and there's all kinds of credit card companies that are offering 0% promos right now. They typically always are, and those are usually 12 months to 18 months, maybe even 24 months of 0% interest. So while you're in that period of 0% interest, if you make a $100 payment, $100 is going directly towards reducing the balance, instead of, in the previous example, of only 58 is going towards reducing the balance. So that's one way to try to get yourself out of credit card debt. That's the end of what I had prepared for this topic. As always, if you have certain topics or questions or things you want to learn about, feel free to reach out below in the comments. But if you did get value out of this video, please go ahead and like it, share it to someone who you think might also get value from it. And as I'm releasing new videos in this series, if you subscribe, you'll be automatically notified as those come out. Well, thanks for watching, and see you on the next one.